welcome back to class. Now, as promised, we are taking other financial intermediaries. Now, the term financial intermediary can be used to describe any person or organization that brings together investors and individuals or organizations seeking to raise funds. Are we together? So, in this sense, financial intermediaries include first, some investment banks and commercial banks that deals in the capital markets with investors, buying and selling shares or bonds in the secondary what? In the secondary markets. And also they include stock markets, which provide a marketplace for trading in shares. Provides a marketplace for trading what? For trading in shares. So now let's look at revenue standard, uh, that is the International Financial Reporting Standard IFRS 15, which classifies the streams of income that are qualified as revenue and other income under the words under these relevant standards. Okay, so according to IFRS 15, revenue from contract with customers, revenue is recognized as control is passed either over time or at a point in time. I bought some bags of rice from you, okay, and these bags of rice, you own the shop in Dariko Market, okay, where you store rice, okay, where you store rice. Is that clear? So now I purchased these 3 bags of rice from you, okay, and they are still in your store in Dariko there, okay, but have been issued receipt of sale, but the goods are still in your possession. So in this case, the seller, you as a seller, you are not expected to recognize revenue since the goods are still in your possession. Okay, so now it's only when I come for the goods, or the goods is being delivered to me by you, that's when you should recognize revenue, because if anything happens to these goods while in your premises, okay, then you'll be held responsible. Either you refund my money, or you have me some other 3 bags of rice, okay, or you get me 3 bags of rice alternatively. Is that clear? Yes and yes. Thank you. I love you. You grab once. So control of an asset is defined as the ability to derive the use of and obtain substantially all of the remaining benefits from the assets. Mind you, this includes the benefits, or it includes what? It includes the ability to prevent others from directing the use of and obtaining the benefit from the asset. Yes, I want the 3 bags of rice. No else, okay? No else can what? Can, no else can take out of it, okay? No else can take out of it without giving permission or without allowing such person to do that. Okay, so otherwise, then I have no control over it. Okay, I have no control over it. I have no say over it. You own the car, and you could not stop others from using this car wherever they would like to, and even this car you cannot use it as your own what. So you don't, in that case, you don't own the car. Okay, you don't own the car. So it's either what, the whole family owns the car, or it belongs to a community or an institution. Okay, because if it is yours, you could deny other people access. You could deny others access from using it. Okay, so now control of an asset is defined as the ability to prevent. Okay, as the what? Okay, sorry. Let's take this one here. Control of an asset is defined as the ability to direct the use of and obtain substantially all of the remaining benefits from the assets. Are we together? Mind you, he also bears the burden as well Okay, that's the risks. Okay, so the benefits related to the assets are the potential cash flows that may be obtained directly or indirectly. So this includes but are not limited to using the assets to produce goods or services, using the asset to enhance the value of other assets, using the asset to settle liabilities or reduce expenses, selling or exchanging the assets, pledging the asset to secure a loan, and holding the assets. Okay, so an entity recognizes revenue over time if one of the following criteria is met. If one of the following criteria is met. One is that the customer simultaneously receives and consumes all of the benefits provided by the entity as the entity performs. Okay, the customer was simultaneously receives and consumes all of the benefits provided by the entity as the entity performs them. Okay, so such as what let's say uh, a concert, is that right? Okay, or media houses, okay, so like a TV show and the likes. Okay, so also the entity's performance creates or enhances an asset that the customer controls as the asset is what is created, or the entity performance does not create an asset with an alternative use to the what to the entity, and the entity has an enforceable right. This should be together. Has an enforceable right to payment for performance completed to date. Okay, so revenue streams are the various sources from which a business earns money from the sale of goods or the provision of services. So the types of revenue that a business records on its accounts depend on the types of activities carried out by the business, like the telecommunication businesses. Okay, you purchase an airtime of let's say 1,000 naira. So if you still have these 1,000 naira on your mobile, Glo, MTN, Airtel, or whatever network cannot recognize that 1,000 as a revenue. Okay, so they only recognize it as a revenue when you begin to call. Okay, when you start using this airtime on your line. Okay, so your first call you use 50 naira, the next call you use 200, the next call you use. So they recognize this revenue substantially, gradually, as you enjoy this service, because you get this airtime for 1,000 naira. So as you make calls, you are enjoying the services. Okay, you are receiving what you are receiving the benefits. Okay, as well you are paying for it at the same time. Okay, so at the point you purchase the airtime belongs to you, so you can control the use of the airtime. Okay, you might decide to use the whole 1,000 naira to call your girlfriend, or to call your fiancé or your spouse. Okay, so you can use that the whole 1,000 naira. I'm talking to John. Sorry, John. Let me, Michael, you have. Oh, sorry if that's your name. I'm very, 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 very sorry. Now we are back in class. So you might decide to use that the whole 1,000 naira to call your girlfriend or your boyfriend, in whichever case. So in that case, you control it. You control the use. Mind you bear the cost of 1,000 naira. That's the in fact. And the risk is, what if you've activated a services on your mobile, so or you've like maybe you've loaned airtime from the service provider, so as you are recharging the 1,000 airtime, they deduct your previous loan. Okay, so that's just it. So you can control you can control what you can control the benefits. You can control what the benefits enjoyable from that. Are we together? Okay, so revenue streams are what are the various sources from which a business earns money from the sale of goods or the provision of services and the types of revenue that the business records on its account depend on the types of activities carried out by the business. Let's take the types of revenue. Types of revenue. And mind you, generally speaking, the revenue accounts of retail businesses are what are more diverse, more diverse as compared to businesses that provide services, isn't it? Yes, and yes. Now, what are the types of revenue new to you? To classify revenues at a high level, there are operating revenues and non-operating revenues. Operating revenues describe the amounts earned from the company's core business operations. We can call these active what? Active income or active revenue, and non-operating revenues refer to the money earned from a business side activities, and this could be called passive what? Passive income or passive revenue. Am I speaking sense at all? Yes, sir. Thank you. If that should be the case, we are progressing, right? Yes, sir. Okay. Many different revenue accounts are used by businesses in various industries. For the majority of companies, the following are a few common revenue accounts. Are we together? Yes, sir. Now we have our revenue from goods sales or service fees. Now this is the core operating revenue account for most businesses. For most businesses, it is what? It is the core revenue. Core what? Core revenue account for most businesses, and it is usually given a specific name such as sales revenue or services revenue. Sales or what? Sales or service revenue. So if a company is into what? Is into the production of beverages, any sales from these, any money made from the sale of beverages will be classified as its active income, operating revenue. Is that clear? So that's sales or sales revenue. And if you are renting professional services, okay, such as dry cleaning services, so any money earned from provision of your services or while rendering services to customers, okay, so that will be classified also as operating income. Meanwhile, because you are in a service industry, it is called service revenue. Are we together? So we also have interest revenue, and this account records the interest earned on investments such as debt securities, and this is usually a non-operating revenue if it is being earned by non-investment company, okay, or non-banking non-banking and other financial institution. Non-banking and other financial institutions. So it is being performed by, maybe you have what, an investment, okay, so you loan, or you have a loan or a fixed deposit, okay, so now any interest earned on these investments, okay, so such as debt securities and the likes will be classified as interest revenue, and if it is owned by a company, okay, so for such company it is non-operating income, non-operating revenue. It is passive, okay. So also we have a rent revenue, and this account records what the amounts earned from renting out buildings or equipment, and is considered non-operating revenue, except you are in a real estate management, okay, that is you are operating as a real estate. Are we together? Yes, sir. Or you are an investment company. So in such case, like income earned on investment property, okay, So if that is the business you are into, it will be recognized as an operating, and if not, maybe you have a building or 4 apartments and you are using 3 for business purposes, and the other one is being let out to a third party. Okay, so any income received from these other apartments will be what will be classified as other income, and in such cases it is what it is a passive income. So also we have a dividend revenue, and this is the amount earned from holding stocks of other companies, and this is also non-operating revenue. Are we together? It is what? It is also non-operating revenue. We are progressing, right? Yes, thank you. Now let's take the accounting treatment of hedging transactions, and also we shall discuss its income tax implications. Now, what do you understand by hedging? Hedging transaction means any transaction entered into by the taxpayer in the normal course of the taxpayer's trade or business, primarily to manage the risks of 1. Price fluctuations or price changes or currency fluctuations with respect to ordinary property, and interest rates or price changes or currency fluctuations with respect to borrowings or ordinary obligation, or such other risks as the secretary may prescribe. As what? As the secretary, this should be security, okay, may what? May prescribe. We together. Yes, sir. Okay. So now we are progressing, right? Yes, sir. So you want to purchase an asset from London, okay, or let's say from USA, and you pay in dollar, okay. Now imagine there's a fluctuation, there's a fall in naira value, okay. So now currently let's say naira value is 320 to $1, okay. 320 to $1. So at the time you are purchasing, you the naira or the exchange rate is 320 to $1. So now you purchase on credit. Now you might decide to hedge this transaction, okay. You might decide to hedge this transaction should the case in future date there's fall in price, maybe naira is now strong against dollar. So for every 300 naira is exchanged for $1 instead of 320. So now naira is more stronger, is a bit stronger than a dollar in this case, because it's strengthening by 20 naira against what? Against $1. So in that case, if you have held this this transaction at the date it was made, then you pay less of the dollar amount of the item you purchase. And if is in the other case, then you pay more. But once you have hedged it, there's no there's no cause for alarm. You still pay the same amount because it has been hedged as at the time of purchase. Now let's take a snapshot of the most significant areas of change for hedge accounting. Okay, now let's look at the hedge effectiveness testing. Now this is prospective only and can be qualitative depending on the complexity of the hedge. Okay, now like the 80% to 125% range is replaced by an objective based test that focuses on the economic relationship between the hedge item and the hedging instrument and the effect of credit risk on that economic relationship. Are we together? So now let's look at the risk component. Now this may be designated as the hedge item not only for financial items but also for non-financial items, provided the risk component is separately identifiable and reliably measurable. Okay, so we also have a cost of hedging. Now the cost of hedging is that the time value of an option, the forward element of a forward contract, and any foreign currency basis spread can be excluded from the designation of a financial instrument as the hedging instrument and accounted for as cost of hedging. The time value of an option, the forward element of a forward contract, and any foreign currency basis spread can be excluded from what from the designation of a financial instrument and as the hedging instrument and what accounted for as cost of hedging. So this means that instead of the fair value changes of these elements affecting profit or loss, okay, that is when I say fair value, it means the current market value, okay. So instead of it affecting the elements the profit or loss rather, like a trading instrument, these amounts get allocated to profit or loss similar to transaction costs, so which can include basis adjustments, and while fair value changes are temporarily recognized in other comprehensive income. Okay, are we together? So let's look at the hedging items. The general requirements of what qualifies as an eligible hedge item are unchanged compared to IAS 39 financial instruments. So now a hedge item can be one, a recognized asset or liability, an unrecognized firm commitment, a highly probable forecast transaction, or a net investment in a foreign operation. So this mind you, all of the above, all these, okay, can either be a single item or a group of items. So provided the specific requirements for a group of items are met, okay. So only assets, liabilities, firm commitments, okay, and forecast transaction with an external party qualify for hedging accounting. Only forecast transaction, firm commitments, liabilities and the likes, okay, with external parties qualify for hedge account. So as an exemption, a hedge of the foreign currency risk of an intra-group monetary item qualify for hedge accounting if that foreign currency risk affects consolidated profit or loss. So in addition, the foreign currency risk of a highly probable forecast intra-group transaction would also qualify as a hedging item if that transaction affects consolidated profit or loss, affects consolidated profit or loss. So these requirements are unchanged from IAS 39. As with IAS 39, the item being hedged must still be reliably measured. Okay, so also from IAS 39, a forecast transaction must be highly probable. However, what has changed in IFRS 9? IAS 39 is now IFRS 39. So whenever a new standard is being issued, or a old standard is being revised, so it will be reissued in IFRS. So it is IFRS 9 and not IFRS 39. So are we together? So compared to however, what has changed in IFRS 9 compared to IAS 39 is how hedge items are designated in a hedging relationship. So in particular, the designation of risks and nominal component and the designation of aggregated exposures and groups of items have also changed. So these changes which should ultimately lead to more risk management activities qualify for hedge accounting, all stem from the broader goal of the hedge accounting project to better align an entity's risk management approach with the accounting outcome. Are we together? Now